How are you guys doing? Today I want to compare robo-advisors to the banks or investment firms, and I've got to go back a little bit before I start and talk about how K4 started and why. And at the time, years ago, about 5 years ago, I was at Investors Group, and at the time they had bought Wealthsimple, and Wealthsimple was pretty new, and I was wondering, why and what their plan was, and they just wanted their hand on the pulse because they knew it was sort of the future. They just didn't know how, so they wanted a part of it. And around that same point in time, my granddad had passed away and had left us with a little bit of money, and I was sitting there thinking one day, and I said, if I'm just thinking about this as an advisor and my own advisor, I would prefer to not be selling myself the funds that I am telling my clients to invest in. I would prefer to go and get my clients to or invest my own money in something like Wealthsimple that is going to cost less, because everything that I had learned over the years, with the exception of what I was learning in our sales training, was that if you reduce fees, you go into low-cost ETFs, and you have a well-built portfolio there, then you should generally outperform any other actively managed mutual funds that are traditionally sold by companies and financial planning firms like Investors Group and all of the banks. Now, the thing that I talked about last week was that, how do you find an advisor that's right for you? And a big part of that was me talking about, I know that there are fees and they're going to eat into your investment returns, but sometimes advice is very important. So what I'm trying to do is talk to people that aren't getting any advice and are just going in potentially to their bank branch and saying, I want to put money into my RSP, and you put your $10,000 in a year and you've got $100,000, and that's really all that's happening. You're not getting any advice. You're just buying this fund at the bank and you're paying fees and you don't really know what's going on. So the whole purpose of this channel, for one, first was, obviously I want to drive a little bit of business to my own practice. But beyond that, it's not like I can take on 10,000 clients, right? So it's not like I'm like, my God, I need every single person in Canada to be a client. It's not anything like that. But what beyond that, I want to educate people so you can be your own advisor. You can teach yourself the fundamentals of financial planning and then pay a little bit of money to a robo-advisor of your choosing to invest that money for you. It will be well invested, and you can pick and choose how you're going to put money into your RSP, into your TFSA, how you're going to draw it out in retirement, when you're going to take CPP and OAS. If you need some additional advice, then there are places to get it. You can pay for a plan, you can come to us, you can do whatever. But this is for people that are just going into the bank and putting the money in, and I really want to try and convince you that that isn't the right place for your money, and I'm going to talk about it. And at the end, this video is a little bit of a sales pitch. There is a chance for me to make a little bit of money off of this, but that's not a bad thing, I don't think, and I'll be very upfront about it. But I'm going to compare just a bank mutual fund to Modern Advisor, because I now have a relationship with Modern Advisor. It's very good robo-advisor in the country that I like, that I'm working with, so I'm going to recommend them. So we're looking at a traditional bank's mutual fund. The biggest one in the country is called RBC Select Balanced Portfolio. Nothing wrong with this mutual fund whatsoever. It's well built, it's professionally built. It costs 1.95%. So if you have $100,000 in there, it's costing you $1,950 per year just to have that your money in that portfolio, and you're hoping that it's going up. And so if you look at every single one of the big five banks, they have almost identical portfolios. So you go in, you fill out your risk questionnaire, it says you're a balanced investor. You know, Scotiabank is going to have theirs, TD is going to have their Comfort balanced portfolio, CIBC is going to have one. And if you looked at the insides of every single one of these, they would basically own almost the exact same things, come with a little bit different fees, and their investment returns are going to almost match each other because they're going up and down with the same market that we're all in. And you know, some of them are going to outperform the other ones, but you're never going to know which one is going to do better than the other until you look back. So anybody that's like, look how well this one did, doesn't really mean that it's going to outperform the other one later. Just the same as me saying that reducing your fees and doing this is going to guaranteed increase your investment returns, because it won't. It will not guaranteed do that. However, it is going to significantly increase the likelihood that you are going to get a better return because you're paying less for this. I mean, if you just think about it, you have more money invested every single year because less is going towards the institution, then there is a better chance that it's going to get a better return. And even if that mutual fund does beat the low-cost portfolio, generally speaking, it barely beats it by any real margin if you're really looking at it over the long term. So when I talk about this, I talk about this very seriously. It was the driving force behind the entire purpose of this business was, guess what? I know that people should be investing and paying less. So I'm going to start a business and have some weird YouTube channel where I make silly jokes and try and teach people about money and just hope that that works. And luckily for me, it kind of did, but I wouldn't recommend it to anybody. But so, you know, this, if you look anywhere, you look at any blog or you look at any research, they're going to talk about this. And the only people that aren't talking about this are the big financial institutions that are still holding on to the idea of saying, you know what, you know, our high fees are worth it because we're getting these great returns. But if you look at all the banks, they do have those lower cost options. You just can't actually talk to anybody to do them. So they're sort of saying, you know what, we have them, but if you want to talk to anybody, you know, like, you don't even think about it because they have to sell you these higher priced things. So, I mean, you're just paying a whole lot of money for sort of nothing. And so now what I want to do is I did something fun and I used Excel, which I haven't like totally gone down the Excel rabbit hole in a while, and it was fun for me because I got a new computer. So I was like, okay, well, let's look at somebody that has $100,000 and they go to the bank and they're paying 2% in investment fees and they're putting in $500 a month from the age of 35 until 65. This seems fairly reasonable. This could happen. This is an individual that could be out there. And that's all they're doing. And let's say that the market in general was going to return 7%. But now what we have to do is minus off the fees. So you're paying about 2% in fees. So can you imagine if, you know, you bought an RSP at the bank, you had $100,000, and then this is what you saw. You said, okay, I got a 10% return, so I made $10,000 last year, but then it showed you, oh, but you had to minus off $2,000 and throw it away because that's what the bank charged you for this. Well, that's exactly what's happening. They're just not showing you that. And the problem that I have is that my clients actually see that. So when, you know, Wealthsimple sort of said, you know what, Kent, we don't want your business anymore, all my clients that saw my fee and were like, oh, you know, Kent makes pretty good money, you know, and we haven't talked to him and we're kind of like upset or whatever because we don't like this transition, let's not pay him anymore. So it was sort of like, and I knew that that would happen, and that's totally fine. I mean, that's my fault, you know, for making that happen, but I'm just saying my clients actually get to see that. So even though my fees are lower, I'm still at a little bit of a disadvantage compared to a lot of these firms out there because you don't see that coming off. But let me actually show you what it really looks like. So, you know, we're just going to look at this portfolio value, and it's going, and we're going to go for 30 years. And so in 10 years, the portfolio that made 7% but got 2% peeled off every year is at $245,000, and they're paying about $4,900 per year in fees now. And in 10 years, they're at $481,000, and now they're paying about $9,600 per year in fees. And they don't even really see this, but this is what somebody with a $500,000 portfolio is paying. Now, at about this time, about the $500,000 range, somebody from higher up at the bank in the brokerage is going to start knocking on your door and say, you know what? Now is the time where you're going to get better service because we're charging you $10,000 a year, so you're totally worth it to us now. Doesn't mean we're going to reduce your fees, but we're going to give you better treatment. And you're like, yay, I've made it, I did it, now I get my $10,000, gets me into a nicer office building. That's very exciting. And at 30 years, you have $869,000, and you're paying $17,000 per year in fees to the bank for the luxury of them managing your money and putting it into their mutual fund. And at the end of the time, you have $852,000. Decent amount of money. And so they're saying, look, we've earned our fee. We turned your $100,000 into $852,000. We're absolutely fantastic. But let's look if you went and did this on your own and then paid somebody for financial advice every once in a while or whatever, or just watched my videos enough that you actually learn enough to be your own advisor. Well, now you're only getting 0.6% peeled off every year because that's Modern Advisor's fee. And at 10 years, you've got $274,000. Your annual fee is about $1,600. So the 10-year mark, not a huge difference. But now the snowball effect is about to start happening. And at 20 years, you've got $603,000 compared to the $481,000. You're up $120,000 in 20 years. You're paying $3,600 per year in fees compared to $9,600 over at the bank. And that's actually low fees compared to a lot of bank mutual funds that are higher than 2%. So I was even giving them a break on this. And at 30-year mark, you've got $1.225 million compared to the $869,000 over at the bank, and your fees are $10,000 less per year. So your fee difference, the difference in fees that you've paid to different institutions, is $151,000. But you also had this extra $151,000 that had the ability to grow with the market. So now your portfolio difference is $365,000. So it's a huge difference. You see those like Quest Trade commercials or whatever where they're like, you can retire up to 30% wealthier if you invest in our portfolios. Well, that is why. Because they're building very similar things, and inside they own very similar things. And I'm not saying that I'm not a portfolio manager, so I don't know which portfolio is built better for the long term. However, I know that one costs a lot less than the other, and if you actually broke them all out in the open, the holdings inside of them would be very similar. The biggest holding in the RBC fund is Apple, Microsoft, and Royal Bank, and I bet you if you looked at the biggest holdings inside Modern Advisors portfolio, they would be very similar. You know, Canadian banks, RBC being the biggest, Apple, Microsoft, absolutely huge companies. You're going to own a pretty big portion of them inside of that portfolio. So, now to my sales pitch, which you know, we're going to post on a lot of videos because why not? But basically, we've come to a deal with Naveed and the guys at Modern Advisor, and I'm going to have him on the channel to talk about his company and you know, his beliefs, and he's a great guy. But what is going to happen is anybody that uses the code that we're going to link to our videos, you will get your first month at Modern Advisor managed for free. We're not going to see anything except that somebody used that link, and for that reason we're going to get compensated $50. So hopefully you're a client with them for a long time, you keep watching, you know, a little bit of helping us, and then hopefully all of that money can go back into me producing more videos and doing more and teaching a lot more in the months and years to come. So just a way to hopefully monetize the channel a little bit more and sort of take advantage or make a little bit of money after years and years of sort of going up and down and getting this business off the ground. So thank you guys again very much for watching. Please subscribe if you haven't, and check them out. If they look good to you, I certainly encourage you to invest over there, at least with a portion of your money, to see how it works out for you. Thank you very much.